All right, welcome back, guys. So here is the study guide for the midterm exam. So this is what kind of questions I could be asking you on the exam, right? So kind of geared towards this study guide, right? Now, of course, not everything on the study guide is going to be on the exam. So again, you also are responsible to make sure that you do know certain concepts, certain things, right? Because again, I might not have covered it in the study guide. So you are still responsible for that, okay? Again, you guys have all the quizzes, all the exercises, as well as including this study guide too, as well as the previous study guide. You have multiple of examples to be able to help you take your exam, right? And I will be giving you guys a hard copy on the Google Classroom. Okay, I will upload it right after class. But other than that, this exam, you can use anything that you want for the exam. And you guys have 3 attempts and you have 4 days to complete it, right? So you guys have Thursday, Friday, Saturday, and Sunday. So make sure you guys are, ready for that. So let's go ahead and take a look at what we could do here. So I did it in order so we can be in order. So starting with chapter 2, right? This is what we learned, right? So I'm going to be asking you this series of questions where I'm going to give you an account. You're going to determine the account type. You're going to determine the category, and you're going to determine whether it has a debit or credit balance, right? So number 1, right? Checking. What is checking?
It's an asset.
It's an asset. That's correct. What kind of asset?
It's a fixed asset.
Not a fixed asset because what is checking already has cash in it. So
Right.
cash is already readily available.
Okay, can you pull that down a little bit so I can see the categories for section 4? Okay, it's a current asset.
It's a current asset because it's already in its liquid form. All you need to do is go to the bank and pull out cash or use your debit card. Right? And what kind of normal balance would a checking account have?
Debit.
It would have a debit. So this is where your accounting model is going to help you out here. Okay. What about an accounts payable account?
It's a liability.
Correct, right? This is where we owe vendors. Now, what kind of liability?
Expense.
It's not an expense. You already established it's a liability.
Liability.
What kind of liability?
Long term.
No. So long term means that you owe this vendor for more than a year.
Is it current?
It is current because you're going to owe them less than a year. Now, what kind of normal balance would an accounts payable have?
Credit.
It would have a credit balance. Good. What about inventory?
That's an asset.
It is an asset. You do own your inventory when you acquire it. What else? What kind of asset?
Uh,
fixed?
It's not fixed. Now, fixed, okay, it's going to be a PP&E, right? What is PP&E? It's your property, plant, and equipment. Does your inventory fall in any regards in any of those categories? Does it belong to the property? Property meaning the land, the parking lot, the streets, the sidewalks. Plant being the building and everything inside the building, the furniture, the desk, the lamps, the chairs. And then equipment, anything that helps the machine operate, right? Or the business operate. So any type of machinery.
Is it current?
It would be current because you can turn around this the inventory and convert it into cash very easily. Okay? So what kind of balance would this normally have?
A debit?
Okay? What about supplies expense?
Okay, that's a liability.
Supplies expense?
Um,
Operating expense.
It's an operating expense. Good. So therefore it's an expense and it's operating expense. Good. Now what kind of normal balance would a supplies expense have?
a credit?
Not a credit. It's an
Debit?
expense, right?
Mm-hmm.
How do you increase an expense?
You debit it.
You debit it. Good. Okay. What about the accumulated depreciation? What is the accumulated depreciation?
Would that be an expense?
In this case, it's the accumulated is not an expense. Okay. So in this case, right, where does accumulated depreciation appear? When do you use the accumulated depreciation?
On your inventory?
Not your inventory.
Hmm.
We just learned about it in chapter 11. Where does the accumulated depreciation come from?
May I see the account type again?
Owner's equity?
It's not an owner's equity. So in chapter 11, what did we learn?
Okay. Would the appreciation would it be income?
No, we're not
Oh,
earning anything. So I
it's a
heard a lot
loan.
of mixed things. Okay, I heard. So Norman, what did you say?
Asset?
Assets, right? We talked about what happens when you need to depreciate your fixed assets, right?
Okay.
What happens when you need to lower the value of your used couch, right?
Right.
So what is the accumulated depreciation? It's a contra account. What is it a contra account to? Where does the accumulated depreciation come from? It's a contra account to
Um, I guess your like your furniture or
what do we call those?
the P the PPLs.
The PP&E. But what's PP&E called? What account type is PP&E, and what category is PP&E?
Okay, it's an asset.
It's your assets. What kind of assets?
Okay.
Current.
Not current. We just talked about PP&E. Where does PP&E come from?
Fixed.
Okay, is it
Fixed.
fixed asset?
It's a contra account to your fixed assets. So if it's a contra account, then what is its normal balance?
Is it a debit?
If you increase your assets with a debit, what does a contra account do?
It decreases it.
It decreases it. So how would you decrease a fixed asset?
Credit.
Credit.
You would credit it. Okay? What about the bad debt expense?
That's an expense.
It's an expense. What kind of expense?
Long term?
There's no such thing as a long-term expense.
It's a liability?
It's not a liability. We just established it as an expense.
Okay.
Where does...
Can I,
Go ahead.
I need to see the account type. I mean, the category. Would it be an operating expense?
It is an operating expense. Okay, now what kind of... So, the bad debt expense, where does it come from?
Credit.
Okay. No. How do you increase expenses?
Debit.
You debit the account. So where does the bad debt expense come from? We just learned this in chapter 10 too. We reviewed this yesterday. Where does bad debt come from?
Allowance for doubtful accounts.
Allowance for doubtful accounts. Good. Which comes from the accounts receivable. Okay, good. I have inventory in here twice, so you could skip that. Next one is unearned revenue.
Income. Operating income.
No, it's not. You haven't earned the revenue yet. So,
Accounts receivable.
you can't use accounts to determine accounts. It can only be an asset, liability, equity, revenue, or expense. And in this case, this is a trick one because it says it's unearned revenue. You haven't earned the revenue yet. So in this case, where does an unearned revenue come from? It's when customers pay you in advance for services you haven't completed yet.
So would it be other income?
It would not be other income. You haven't earned it yet.
Okay.
If a customer pays you for services you have not done yet, what's your obligation?
Would it be considered an asset?
Well, no, because a customer paid you in advance for services that have not been completed yet. A customer pays you money in advance for services you haven't completed yet. So what's your obligation?
Okay, can you pull it down a little bit? I can't see the, okay. Would it be income?
No. You haven't earned the revenue yet. That's hence the word unearned revenue. Now listen again. If a customer pays you in advance, they made a customer deposit, right?
Mm-hmm.
What's your obligation? You haven't done them any service yet. So what's your obligation?
Operating expense?
It's not an operating expense. Again, a customer gives you money and you didn't do anything for them. What is your obligation?
Goods or services?
You owe them goods and services, right? So what does it mean to owe?
Liability?
It's a liability. You haven't done the service yet. That means you are obligated to complete the service because they gave you money in advance, right? Oftentimes,
Okay.
a customer will pay you in advance. That means your obligation is you have to provide that service now, right? Now, what kind of liability would this be?
Would it be long term?
Now, is there any possibility if a customer gives you money, right? You're going to keep it for a whole year and not do any services for them for one whole year?
Current.
It would be current. 100%. Right? Unless it's like holding a wedding venue, maybe that will probably be at least 9 to 12 months, but that's still less than a year. Right? I don't think I've ever heard a venue that you had to pay 3 years in advance for. Right? But yes, anyways, that would be an example of paying somebody in advance for services that have not been completed yet. And now in this case, what kind of balance would this liability have?
Would it be a debit?
How do you increase a liability?
That's a credit.
You credit the account. Okay. What about accounts receivable?
Asset?
It's an asset. What kind of asset?
Current?
Current. And what kind of balance would this normally have?
Debit?
It would have a debit balance. Good. Right? This is money that customers owe you. Right? What about furniture?
It's an asset.
What kind of asset?
Fixed?
It is fixed. And what kind of balance would it have?
Debit?
Debit.
It would have a debit balance. Good. Okay. What about owner's withdrawal?
Owner's equity.
It would be an owner's equity. Good. Now, what kind of owner's equity?
Operating expense?
It does that. No, it's not operating expense. That's for expenses.
Can I see the categories? Would it be current?
There's no such thing as a current owner's equity. What was that, Norman?
Other income?
It's not other income. Because that would be an income account, right?
Okay, so would it be other?
There is no such thing as an other owner's equity.
Cost of goods sold.
It is not a cost of goods sold because that's an expense account. This is a trick question.
Sales.
It's
Oh.
not sales.
There's no category.
Owner's equity does not have any categories. Good. So then, what kind of balance would an owner's withdrawal do? Does it?
would be the credit.
Are you increasing your owner's equity or are you decreasing your owner's equity? You're decreasing, right?
So it'd be your debit.
You're going to debit the account. Okay, because owner's equity normally is with a credit balance, but because you're decreasing owner's equity, you're going to be debiting the account. Okay, what about sales?
Income.
It is income. Now, what kind of income?
Operating income.
Operating income, or also known, or if you have sales, then you can use sales. Now, what kind of balance would sales have?
Debit.
How do you increase revenues?
Credit.
It's a credit.
You would use a credit, right? When we always journalize our sales, sales is always on the credit side. Okay, what about cost of goods sold?
Expense.
It's an expense. What's the category?
Operating expense.
It's not operating expense. This is the cost of goods sold. So what kind of category would cost of goods sold have?
Cost of goods sold.
Cost of goods sold. Now, what kind of balance would a cost of goods sold have? Am I increasing expenses or decreasing?
Decreasing.
You're not decreasing.
I mean,
Increase.
So how would you increase a cost of goods sold?
Debit.
You would debit the account. Good. All right, what about depreciation expense?
It's an expense.
It's an expense. What kind of expense?
Is it an operating expense?
It is an operating expense. Good. Now, what's my normal balance? So remember, the normal balance is what's the side that it increases on. So does it have a normal debit balance or a normal credit balance?
It would be a debit balance.
It would be a debit balance. Good. Last account we have here is the allowance for doubtful accounts.
It's a liability.
It is not a liability. Where does the allowance for doubtful accounts come from?
Expense.
It's not an expense.
Other
Where-
income.
It's not income. Where does the allowance for doubtful accounts come from?
Checking.
Not your checking account. Where does the allowance for doubtful accounts come from?
Your bad debt expense.
Well, okay, so where does bad debt come from?
Unpaid debt.
Unpaid debt from which account?
Accounts receivable.
Accounts receivable. This is a contra account. So what is an accounts receivable?
An asset.
It's an asset. What kind of asset?
Income.
No.
Current.
It's Current.
It's a current asset, right? Because this is where your customers owe you money. That means you can turn it around and grab that money from them by simply billing them, right?
Right.
So in this case, that's exactly what it is. It is a current asset. Now this is a contra account to the accounts receivable. So what normal balance would it have?
Debit.
Are we increasing our accounts receivable or decreasing our accounts receivable?
Decreasing.
So what kind of balance would it
Decreasing.
have?
So it would have a credit balance.
It would have a credit balance because right now your accounts receivables, if it's normal, it would have a debit balance, right? That's how you increase your accounts receivable. This is a contra account. Contra accounts flow in the opposite direction. So in this case, to increase an account in an allowance for doubtful accounts, which decreases the accounts receivable, you're going to credit the account. Okay? Good. Next section here, chapter 4, right? Do a little example of gap questions here. So number 4, under the rules of gap, which rule states that when you establish a business, you need to keep your personal and business transactions separately?
Business or economic entity?
Business or economic entity. Good. Business or economic entity. Good. Number 5. Okay. If you purchase a machine for $500 in my books, I must record it as $500. Okay. Even if you plan to sell it for $700, which gap rule states this?
Would it be C?
Historical cost is correct. Right? You have to record your books at $500 even if they have a potential gain. It's always going to remain in your books as $500 until the day that you sell it. That's where you recognize any gains or any gains or any losses. Okay? All right, number 6. Okay? Customer A purchases an item for $15.65 from your store on an account. Okay. After a few days, okay, you receive a check for $15.65. You must properly record this sale and payment. Okay. So which gap rules governs this?
Matching principle?
Matching principle, right? You charged for the sale for $16 and $15.65, and then the customer pays you that exact amount, $15.65. So this is where you're going to match your numbers. So that's correct. Okay. Okay. Number 7. Okay, cash basis is when?
Is it B and C?
Let's see. B says expenses are recorded when it has incurred, and C says revenues are recorded when the sale has been earned. Is that cash basis or is that accrual basis?
A. Revenue are recorded when cash received.
Excellent. With cash basis, your whole operating system is based on cash. If you have cash, you record it. If you don't have cash, you do not record it. So in this case, cash is a necessity in order for you to record your revenues and expenses. So in this case, letter A is the correct answer. Okay. Number 8, which of the following is not a step in the accounting cycle?
Making decisions based on the financial statements.
Excellent. Making decisions based on the financial statements. Okay. Right? Make sure you do know those 10 steps of the accounting cycle, right? It's very important that you do know. Number 9. So moving into chapter 5 territory here, okay? What are the tracking methods used for inventory?
Periodic and perpetual.
Excellent. A, periodic and perpetual. Okay. Number 10. Okay, what are the costing methods used for inventory?
All the above.
All of the above, because specific ID is also existing as a costing method. I just don't teach it, or in this class I didn't teach it. Okay, so make sure you are aware of that. Number 11. Okay, when delivery charges are made on COD, what does that mean?
Cash
Cash
on
on demand. Cash on delivery.
Cash on delivery. Good. Okay. Not code on demand, not currently orders dispersed or discharged, and then not crate on departure. Okay. Number 12. Okay. What is the definition of periodic and perpetual? Excuse me. What was that?
A.
A. Periodic means once in a while, and perpetual means constantly. That is correct. Okay. All right. Number 13. True or false at the end of the period under the periodic tracking method, a conversion entry is needed.
True.
Yes, you need to convert your inventory because under periodic inventory, right, you're going to need to know how to be able to do both periodic and perpetual inventories. So periodic, we purchase them as expenses, and at the end, we have to convert them into inventory. So yes, that is true. Okay? All right, here's an example of a periodic inventory, right? Because that's chapter 5, right? So in this case, key thing that you need to know here is that your tracking and costing method is periodic and it's LIFO. Okay, so number 1 here, or on June 1st, you purchase 100 toys costing $1 each, right? And the freight cost you $25. So June 1st, 100 units at $1 each with a freight of $25. So what is your purchase price?
$100.
What is your total cost?
125.
125.
What is your cost per item since I'm using LIFO?
$1.25.
$1.25. Okay. Then on June 10, you end up purchasing 200 toys costing $1.25 with a freight of $50. Okay, so June 10, 200 at $1.25 with a freight of $50. So what's my purchase price here?
175. I mean 125.
This is 200 units.
Oh, 250.
250 plus 50.
300.
Okay, which will give you a cost per item of
$2.40.
try again. 300 divided by 200.
$1.50.
$1.50. Okay. Then on June 12th, you sold 200 toys at $5 each. No sales tax was charged. What do I do with this sale that I made on June 12th?
Calculate how much you made.
This is periodic inventory.
So you don't do an entry on it, you're only doing the purchases.
We're only doing purchases. So in this case, we can skip that section there. So in this case, next one is June 15. You made a purchase of 300 units at $1.50 with a freight of 75. Okay, so 615, 300, $1.50, 75. So in this case, what is my total purchase price?
450.
450 plus 75.
525.
So what is my cost per item here?
$1.75.
$1.75. Right? And then on June 20th, you sold 250 toys for $5 each. What do you do with this transaction?
You don't transact it. No
Good.
entry.
You don't do an entry. Well, you do an entry for sales, but not in the table. Okay? And then last but not least, on June 30th, you were told that you had a total of 150 toys left on hand. So in this case, I've already filled that in for you. So what do I need to do?
You need to add up your purchase expense,
Mm-hmm.
freight, and total cost.
So in this case, how many items did I purchase in total?
600.
600. What's my total purchase price?
$3.75.
Purchase price, not unit price.
$800.
$800. What's my freight?
150.
150. So what's my total cost?
950.
Good. Right? And we need to keep our batches separate. Now, if I had an ending balance of 150 units, what is my assumption? How many units did I sell?
$450.
450, right? If I had 600 units and I only have 150 left, I should have sold 450 units. You can also go back in here and check right here. If I sold 200 on 15th and I sold another 250, then you add those two numbers together. That gives you 450. So let's go ahead and determine. Let's determine how much it's going to cost me to sell all 450 units. So if I'm using LIFO, right, which batch of inventory am I going to sell from first?
The 300.
300, which is currently at $1.75, right? So how much is that going to give me?
525.
$525, right? So I sold 300 units. I need to sell a total of 450. So how many more do I need to keep selling?
150.
You need to sell 150. So which batch am I going to be taking out from?
200.
The 200, which is currently $1.50. So what I need to do my calculation here. So what is 150 times 150?
300.
$300? Yes, $300?
Hold on.
$225.
$225. Okay? So in this case, that gave me a grand total of 450 units, right? And what's my grand total here?
750.
$750. So that means it cost me a total of $750. So how do I know how much my ending balance is?
Pay 100 minus
No.
750.
Not 800, right? Because that doesn't include my freight. What's my what's my grand total cost right now?
950.
That's how much I have available to sell. And if I sold $750 worth, how much should I have left over?
200.
You should have $200 left, right? Now,
Mm-hmm.
let's take a look at this way too. If I have 150 units left, that means I still have my first batch, which is a total of $125, and I still have 50 units remaining at $1.50. So if you multiply that out, you should get $75 out of that. What's 75 plus 125?
200.
200. Okay? So that's another way that you could solve for it as well. Okay? So, question here 14. What is the total cost of your ending inventory?
200.
$200. Good. And then number 15. What is the total cost of your goods sold?
750.
$750. Okay? Right? So here's another example here. Your tracking and your costing method is periodic FIFO this time. Okay, it's the same exact scenario. So what I'm going to do here is I'm going to copy and paste from here. Okay, so you don't have to do extra work here. Okay, because you got the same exact scenario. You purchase 100 units at $1 with a freight of 25, right? And then on June 10, you purchase 200 units at $1.25 with a freight of 50. So all of those are the same. Okay. Now, here's the difference. This time, my costing method is FIFO. What do I do with FIFO? So if I sold a total of 450 units, right? Which batch of inventory am I going to sell from first?
The first one, 100.
First one, 100. The whole entire amount for $1.25, which we know to be 125. How much more do I need to keep selling? So I only sold my first 100. I need to get a total of 450. So
So you're 200.
you're going to get rid of your 200 batch. Okay? At $1.50, which we already know what that total is. It's $300. So now I sold 300. How many more do I need to keep selling?
150.
You need to
Out of
sell
300.
out of the 300, which is $1.75 each. So you need to calculate this. How much is 150 times $1.75?
Two hundred
200.
two after the cents.
That's correct. So add those up together. So you have a total of 450 units at a grand total of
687.50.
687.50. Okay. So then you have 150 units left. What's my grand total cost ending balance?
262 and 50 cents.
$262.50, right? You could either take it from your $950, right, because that's what you have available to sell, minus the $687.50, you're gonna get $262.50. Or you could see here, right? We already got rid of my first batch. My second batch I have left is the 150 left in my third batch, which is $1.75. We've already calculated what 150 at $1.75 is. It's $262.50. Okay. So, question here is, what is your total cost of your ending balance?
$262.50.
Okay. And what is your total cost of goods sold?
$687.50.
Good. Okay. So last example here, right? This time you have weighted average. Okay, so what's the rule here for weighted average? What difference does weighted average have?
You don't do the yeah, we gotta do the total cost.
You do have to do your total cost.
Okay, you
The
don't
average between the three.
You're going to have to find the average between the three. How do you find the average between the three?
You add them up and divide it by three.
What are you adding up?
Cost per item.
Yes, you could do that. That's another way that you could solve for that. Yes, you'd get the same exact answer. So 1.25 plus 1.5 plus 1.75 divided by 3. And what do you get? It's not the most accurate answer.
as 3.
1.5.
Okay, let's try a different route. Usually that's supposed to work, but in this case, it's not gonna give you the correct answer. How else can I find my average between the three? How do I solve for my average cost per item?
Would it be your unit cost?
Your unit cost, no. How do I solve for my cost per item?
You did the total cost divided by quantity.
So what difference does it make for a cost per item versus a average cost per item? The formula is the same. You're going to take your total cost divided by your quantity, but this time, which one? What numbers am I taking out to get to my average cost per item?
Okay, would you add up the quantity and divide it by 3?
You wouldn't divide the quantity by 3. So if your cost per item is your total cost divided by quantity, right?
Yeah.
What's my average cost per item? Same idea. You're still taking your total cost divided by your quantity, but which numbers are you actually going to be using this time?
Are you gonna be using all of them?
What do you mean by all of them?
Okay, you would do the 950 divided by 600.
Correct. You take the total cost. the total cost, and you're going to divide it by the total quantity. So what do you get here?
Okay. I got 1.5833.
Okay. So that means every item that I sell is going to cost me $1.583333. Right?
Yeah.
So if I have 150 left remaining and I sold 450 units, then let's calculate it, right? What is 450 times $1.583333?
$712.50.
Right? And then same thing, if I want to solve it this way, what's 150 times 1.583333?
$237.50.
237.50. Okay, so in this case, what is my ending balance? 237.50. And what's my cost of goods sold?
$712.50.
712.50. Okay, good. Now I believe this is a continuation, right? Go ahead and practice the conversion entry that we did for right above, right? Because in this case, you're going to use this to answer the next three questions. So in this case, how do I do a conversion entry using the information from above?
Would it be cost of goods sold?
Cost of goods sold is one of them, yes.
And inventory?
Ending inventory, good. And what else?
Hmm. Sales?
Not sales. Under periodic inventory, what do you normally record your purchase of inventory as? That's the distinction between periodic and perpetual.
Purchase expense?
Purchase expense. And what else?
Freight expense?
Freight expense. Okay? How much was your ending balance in your inventory?
$237.50.
237.50. What was my total cost of goods sold?
$712.50.
How much was my total purchase price?
800.
800. And what was my total freight?
150.
150. And if you do your calculations here, your total debits is 950 and your total credits is 950. Okay, good. Number 21. If on June 17 you end up receiving 10 broken mugs, you request a full refund, okay, from the vendor, okay? What accounts will be journalized for this return if you are using the periodic method?
debit purchase returns and allowance.
You wouldn't be debiting a purchase returns and allowance because in this case, if you originally purchase your items, right, you already are debiting your expense account. You are returning these items. So how do you decrease a purchase expense?
Credit.
You would credit the purchase returns and allowances. Good. Okay. 22. Okay. If terms are 5%, 15, net 30, what does this mean?
A.
A. Take a 5% discount if you pay within 15 days. If not, pay in full within 30. Good. Okay. Number 23. What does net mean?
We take the discount later?
No. So think about gross pay and net pay. What's the difference?
Take the discount immediately.
Yes, you're going to take the discount immediately, right? You're going to discount or subtract whatever amounts that you will get, and then you get your net pay at the end. Okay. Numbers. Oh, so now we're moving on to chapter 6. Okay, chapter 6, question 24. Okay, if a customer buys 10 shirts for $5 each, sales tax is 8.25%. Total cash sales was for $54.12. Okay, and then the next day, the customer wants to return 5 shirts because they were the wrong size. Okay, and then of course the customer demands a full refund for the 5 shirts. What should the journal entry look like? Assume that you are using periodic inventory. So which one would you do?
Would it be D?
Let's see. You got sales returns and allowances and cash. Now, what did we charge our customers?
A.
You're going to be giving cash back and you're going to credit your sales returns and allowances with sales tax. Are you receiving money?
No, you're giving money.
You're giving money back. So A is definitely not an answer.
So would it be, okay, where is it?
C.
C?
So that was the question I was asking, right? You
Uh-huh.
charge sales tax, right?
Right,
If you're returning a product, you are obligated to give the portion of the sales tax money back.
right.
So C would be the correct answer. Right? 25. Okay? When there is a store-wide sales discount for 40% off, you can only take a discount off of which items?
The
A.
merchandise selling price.
Correct, right? You can't take a discount off of sales tax. You can't take a discount off of shipping, and you can't. There's none of the above is not an answer. Right? So use the following tables to answer the question. So here's a lower cost of market, right? Your original cost was $4.75. Your replacement is $4.05. You sell this product for $10.50. To dispose, it's going to cost you $1.33, and the amount of profit is $3.55. So how do I solve for my ceiling?
It would be the sales price minus the cost of disposal.
Good. Selling price minus disposal. So that is what? Right now that's $10.50 minus $1.33. So how much is that?
$9.17.
$9. Okay, yeah, $9.17. Okay, good. Okay. How do I solve for my floor?
The ceiling price minus the amount of profit.
Good. So that's going to be $9.17 minus $3.55. So what should my floor be?
$5.62.
Okay. So then how do I determine my market? I need to compare, right? What numbers am I comparing?
The ceiling price, the floor price, and the replacement cost.
Good. My replacement cost is 405. So which one's in the middle?
562.
562. So in this case, last question is which one's lower? My market cost of $5.62 or my original cost of $4.75?
Your original cost.
Original cost of $4.75. Good. Okay. Let's see. Okay, we're doing good so far. So let's go ahead and go through chapter 7 and then we'll take a quick break. Okay, 27. Your tracking method is perpetual. Okay, so on June 1st, you made a purchase of 10 coffee mugs for $2.35. I meant 100. All right, each. With the freight costing you $100. Okay, and you purchase this on an account. Record this transaction. So, how do I record a purchase of perpetual inventory?
You would do
Monthly.
mugs.
Mugs. How'd you purchase these mugs?
So accounts payable.
Okay.
And freight.
Mm. Do you separate freight for this?
No.
Where does the freight go?
It would be in the cost of the mugs.
Correct. So in this case, how much am I going to put into my mugs account?
100.
Okay, what about the actual mugs?
Okay.
$235.
Okay, so $235 plus the 100.
$335.
Okay, everything goes into inventory. Okay. Number 28, on June 7, okay, you received your coffee mugs and found 2 of them were broken, okay, or cracked. All right, and you requested for a refund on your from your vendor. Record this transaction. Okay, so you already received your cups, and now you found that 2 of them are broken. So how are you going to request a refund? Assuming that these are related.
Purchase returns and allowance.
We're under perpetual inventory. Where did you put your inventory? Mugs. So where are you gonna take it out from?
Mugs.
You're gonna take the return out of the coffee mugs. Good. Okay? Now, in this case, what happens when I remove from my coffee mugs? What else do I have to remove this amount from?
The accounts payable?
Yep, I have to reduce the my liability. I'm going to owe less because the refund is going to decrease my bill. Okay? Now, how much am I going to decrease my bill by?
2 mugs.
2 mugs. How much did it cost me?
$4.70.
$4.70, right? So in this case, we're looking at $2.35. $2.35 times 2 will give you $4.70. Good. Right? We can't include the price of the freight, right? We can only get a refund on what the original cost price was. Okay. All right, number 29. Right? Number 29 says on June 8th, you sold 25 mugs for $10 each, and it cost you $3.37 each. Okay? So assume there's no sales tax. All sales were made with cash. So I sold 25 coffee mugs for $10 each.
So it would be
$250.
$250. Which account am I going to be debiting and which account am I going to be crediting?
okay, you're gonna be crediting cash.
Why would you be crediting cash? Am I paying somebody?
Oh, I mean, I saw it. You're gonna debit cash.
You're going to debit the cash. Good. And
would it be sales?
yes, you would credit your sales because you earned the income. Now you said how much? It was $250, right? You sold 25 of them for $10 each, so that's $250. Okay? This is perpetual inventory, so what do I do?
Conversion.
You don't need to do a conversion because your inventory is already inventory. There's no need for a conversion entry. What did you do?
So it would be you would be decreasing your inventory.
You would be decreasing your inventory, okay? Your inventory was the coffee mugs, right?
All right.
Now, what else are you going to also be recognizing?
Cost of goods sold.
The cost of goods sold, right? You need to calculate how much it costs you to sell these 25 cups. So in this case, how much?
Was it $84.25?
$84.25. Okay, so in this case, it's gonna cost me $3.37, and I sold a total of 25. So it's gonna be $84.25. Right, that's what it cost me. But because I sold it for $10 each, I received a profit out of it. So that's the goal here, right? Okay. Number 30, okay? If on June 10, a customer returns 2 of the coffee mugs for a full refund, okay? And you sold each mug for $10 each, and each cost you $3.37 each. Record this transaction. Okay, so in this case, a customer decides to return 2 of the coffee mugs. Yes.
So like on the exam,
Uh-huh.
are you gonna have us recording stuff, or are you gonna have like the answers in the form of what would be on the recording?
Yes, so it's going to be all multiple choice. So it's exactly like we did from the first exam, right? I'm going to give you A, purchase expense for this. B, sales returns and allowances for this. C, cash. And D, right? So in this case, I do give you the answers to the questions. You just have to make sure that you select all of the options if there is an available option. Okay, so meaning if there's a letter E that says A and C, right? Make sure you do your journal so you can see if this is all the answers that I need. Okay? All right? So here you go. If a customer returns 2 of those coffee mugs for a full refund and you sold each coffee mug for $10 each, right? And of course, it cost you $3.37 each. So how do you record this return?
Mugs,
In this case, you're not going to recognize that just yet. What's the transaction at hand? What did the customer do?
sales returns.
Sales returns and allowances. Good, right? The customer returned the product. Okay? And what are you going to give back to the customer?
Cash.
Cash, right? Now, if you sold those cups for $10 each and the customer's returning 2 of them, how much are you going to be giving back?
$20.
$20. Now, since the customer is giving you back the product, what are you going to do?
That's going back in inventory.
Increase your inventory and
Cost of goods sold.
you're going to undo your cost of goods sold. Good, right? Because it's as if you never sold it in the first place. Now, if each item cost me $3.37 and I'm returning 2 of those items, how much is going to be my total here?
$6.74.
$6.74. Okay, good. All right, so let's go ahead and stop here for a break, and then we'll finish up with the rest, chapters 8 through 11, okay? So let's go ahead and take a quick break here. So go ahead and take